The U.S. stock market is currently closed for the weekend. As of the market close on Friday, October 24, 2025, SoFi Technologies, trading under the ticker SOFI, finished the session at $29.01. This represented a strong move higher into the weekend, with the stock gaining 93 cents or 3.31% on solid volume of over 53 million shares. This Friday rally is exactly the kind of price action that builds conviction for the bulls. But here is the critical piece of information that this surface-level strength completely masks. Wall Street's professional analyst community, on average, believes this stock is worth roughly $21 per share. That isn't a typo. While the stock trades at $29, the consensus price target implies a potential 27% drop from its current price. This is one of the widest and most contentious expectation versus reality gaps on the market right now, and it sets the stage for an explosive earnings report, which is scheduled for this coming week on Tuesday, October 28th. The expectation from the retail community, which is highly active on forums like Reddit, is that SoFi is the future of banking and that this is a generational buying opportunity. The reality, at least from a quantitative valuation standpoint, is that the stock has outrun its fundamentals at a pace that makes many institutional managers deeply uncomfortable. The battle between these two narratives will define the next move. Last week's trading was a perfect miniature of this conflict. The stock was volatile, dropping over 5.4% on Wednesday, only to claw back 3.2% on Thursday and another 3.3% on Friday. This isn't calm, steady accumulation, it's a tug of war. The stock is up over 9% in the last 7 days, but it has largely been consolidating since hitting a record high in late September. This pause is either a base for the next leg up or a top before a significant correction, and earnings will be the catalyst that breaks the tie. The common belief is that SoFi's growth is unstoppable, and the numbers, in a vacuum, are undeniably impressive. The company has been posting record revenues, hitting $858 million in the second quarter. It has now delivered 7 consecutive quarters of GAAP profitability, a milestone that many fintech peers have yet to achieve. Member growth is the core of the bull case, and it continues to fire on all cylinders, reaching 11.7 million members, a 34% jump year over year. Product growth is mirroring this, also up 34% to 17.1 million. This is the story of a company successfully executing its financial services productivity loop, or FSPL strategy, where it acquires a customer for one product, like a personal loan, and then cross-sells them into SoFi Money, SoFi Invest, or a credit card, drastically lowering its customer acquisition cost over time. This is the story you hear everywhere. Now here is the challenge to that narrative. This growth, while impressive, has come at a time of relatively resilient consumer spending. But there are cracks appearing. Buried in recent analysis is a slight increase in personal loan delinquency rates. This is a critical metric to watch. SoFi's high-quality member base, often high-earning professionals, has been its shield. If that shield starts to crack, the entire lending model's profitability comes into question. Furthermore, the stock is trading at a premium valuation. This isn't a hidden gem, it's a well-known growth story with a price tag to match. The market has priced in perfection. If SoFi fails to deliver not just a beat on earnings, but a significant beat and raise in its forward-looking guidance, the air could come out of this stock very quickly. The analyst ratings tell the story of deep division. On one side, you have firms like Mizuho and Needham reiterating buy ratings, believing in the long-term vision. On the other, you have heavyweights like Morgan Stanley holding an underweight rating, and Keefe, Bruyette & Woods, a respected financial services analyst firm, maintaining an underperform rating. They aren't buying the hype, and their thesis is what the short sellers are betting on. Let's talk about that short interest, because it's a crucial and often misunderstood part of the SoFi story. As of the most recent data, there are over 103 million shares of SoFi being held short. This represents about 8.78% of the public float. Now, 8.78% is a significant number. It's not a fringe bet. It shows a dedicated portion of the market is actively betting on the price to fall. This is where many retail investors get excited about a short squeeze. But we have to look deeper. The cost to borrow SoFi shares is currently just 0.27%. That is an extremely low borrow fee. It means that it is neither difficult nor expensive for institutions to take out a short position. This is not the profile of a stock on the verge of a massive forced squeeze event. Instead, it suggests this is a patient, fundamentals-based short. These short sellers are not trapped. They are willingly paying a small fee to bet that the $21 analyst consensus is right and the $29 market price is wrong. They are betting that earnings will disappoint and the valuation will contract. For you as an investor, this data is actionable. You can find short interest data on sites like Fintel or directly from the NASDAQ. When you see a high short interest percentage, your next step should be to check the borrow fee rate. A high percentage with a high borrow fee, say 50 or 100% plus, can indicate a crowded trade where shorts are desperate and could be forced to cover. A high percentage with a low borrow fee, like SoFi's, signals a more strategic, less frantic bearish position. What's your take on the rising short interest? Smart money or manipulation? Comment below. The short thesis is that SoFi's valuation is unsustainable and that its lending business, its core profit driver, is exposed to a macroeconomic slowdown. The counterpoint from the bulls is that SoFi's other two segments are the real story. The technology platform segment, which includes Galileo and Technixis, provides the back-end infrastructure for other fintechs and banks. This B2B business is expected to accelerate significantly into 2026 and provides a high-margin, non-lending revenue stream. The financial services segment, with its checking, savings, and investment products, is what creates the sticky ecosystem and provides the company with cheap deposits from its own members, lowering its cost of capital and insulating it from rising interest rates. To understand SoFi, you have to understand it's not just one company, it's three. First is the lending segment, the original business built on refinancing student loans, which is now expanded into personal loans and home loans. This is the profit engine. Second is the technology platform, a B2B infrastructure play that many bulls believe is the most valuable part of the company long-term, even if it's not the biggest revenue driver today. Third is the financial services segment, the consumer-facing digital bank that aims to be the one-stop shop for its members' financial lives. The bull case is that these three segments create a flywheel. The financial services app acquires members cheaply, who then take out high-margin loans, while the deposits from these members fund the loans at a low cost. The technology that runs it all is so good that SoFi can also sell it to other companies via its tech platform segment. This is the expectation. The reality is that integrating these three businesses is incredibly complex, and the market is still valuing SoFi largely as a high-growth, high-risk bank, tying its fate to the credit cycle. Institutional filings from mid-year, the last full reporting period, show that smart money was also divided but leaning bullish. As of June 2025, 731 institutions held the stock, and total institutional ownership had actually increased to 51% from the prior quarter. Giants like Vanguard and BlackRock remain the top holders, which is typical for a large-cap stock, but the interesting activity was in the hedge fund space. Firms like SquarePoint and Jane Street were significant buyers, while Susquehanna and Renaissance Technologies, both massive quantitative funds, were trimming their positions. This again points to a sophisticated debate, not a one-sided consensus. This was compounded by recent insider selling in late September and October from a couple of executives. While this selling can be for all sorts of reasons, including pre-planned trading schedules, it's never a strong bullish signal right before an earnings report. This is in stark contrast to the sentiment on platforms like Reddit, where you see posts from users who are not just buying the stock, but are moving their entire financial lives over to the platform, transferring IRAs, using the new options trading platform, and celebrating paying off their student loans through the service. This creates a powerful, loyal shareholder base that is less likely to sell during a downturn, but it can also create an echo chamber that dismisses valid, data-driven risks. Looking ahead, the setup for this week is clear. The future outlook hinges on several key catalysts and risks. The primary catalyst is earnings on Tuesday. The market needs to see continued, accelerating member and product growth. It needs to see stable or improving credit quality, especially in the personal loan portfolio. Any sign of rising delinquencies will be punished. And investors will be desperate to hear about the technology platform.
They are looking for signs that this segment is re-accelerating as management is guided. A new large client announcement for Galileo or Technisys could send the stock soaring, as it would help justify the premium valuation. Another potential catalyst is the macroeconomic environment. If inflation continues to cool and the Federal Reserve signals potential interest rate cuts in 2026, it would be a massive tailwind for SoFi's lending business, as it would spur loan demand. The risks, however, are just as clear. The number one risk is valuation. The stock is priced for perfection, and a meet expectations report won't be good enough. It needs to be a blowout. The second risk is the economy. A recession or a rise in unemployment would directly hit SoFi's member base, leading to higher defaults and slowing loan originations. And finally, there is the risk of competition. SoFi is not operating in a vacuum. It is fighting against the largest banks in the world like JP Chase and other aggressive fintechs, all of which are vying for the same high-earning digitally native customer.